Simple hack that will increase your win rate.
Wait. Matron, take them away.
And a warm welcome to one and all. This is your first time here. The big fella, that is the Scruffy Trader. What I'm trying to do is put trading in the real world. Maybe inspire you with your own trading. So if that sounds good, do take a second to hit that little subscribe button. Genuinely helps. If you find value, crack the like, and if you want to see some more, drop in the description and follow me on Twitter for updates. Win rate. How important is it? Well, psychologically, it's incredibly important. And if you're sort of losing all the time, it puts you in the doldrums. And when you're in the doldrums, you get desperate. And when you get desperate, you make rash decisions. This is no good. I am of the belief, if you are under 50% win rate, you're gambling, you're not trading. If you're over 50%, then you've got the edge on your side. That is just simple way of looking at things. And the way I look at it is this. My car costs a fortune to repair. You know, it's very expensive to repair. If it's going to a garage and they can only fix that 4 times out of 10, it's costing me more money. But also it's anxiety, you know, because you don't trust them. This is what win rate is to trading. If you are losing more than you're winning, you ain't trusting your trades. So again, you'll make mistakes. So what does consistency look like? Let me show you. This is a statement of a platform that I'm doing right now. I started this on the 12th of July. I have not had a losing trade since this account opened.
Are you serious?
And I've taken 50,000 to 68,500 in 2 weeks. 59 trades. 58 of them are what's called performance factor. In other words, they're in here. And there's only one, which is there, which, as you can see, is still a profit and still a winning trade. But I had the good sense to kill it because I managed trades. And what does that do for you? Well, you want to see the deal tickets? I'll show you the deal tickets so you can see every single one of them is in profit. There's the top section. I'll just move my head to the bottom so you can read them if you so wish. There you go. And every single one of them is a winner.
No way.
So how do you do it? How do you make life that little bit easier? Well, it's not as difficult as you think. Let's jump on the whiteboard and I'll show you.
Well, we're waiting.
Okay, guys. This is about as simple as it gets. Some are going to like it, some are not going to like it. But trust me, for those who listen, it works. It genuinely does. Because when I'm speaking to traders on a daily basis, and I had it this morning, they're putting on too big a position size for the size of the account, or they're chasing the dragon with leverage. Leverage is good, but it's only there to open an asset, not increase your position size. Because if you're pulling the tail of the dragon, it might work for a few times, but eventually that dragon's going to turn around and it's going to burn you. We don't want to be burnt, do we? Because trust me, just blow your account up. So how can we combat this? Well, first of all, you've got to apply know thyself. Common sense. You know, if you've got a 500 quid account, what on earth are you doing putting £5 and £10 a point on? It'll take next to no time to get rid of it. Madness. See it all the time. So the hack is this. It's very simple. Less is more. Reduce your position size. And you go, what? No, that's not a hack. It is. Because think about this. If you're working on a fixed stop of 20 pips and you're on a market like the DAX, do 20 pips like that before you even blink, and the chances of you timing the market to within 20 pips of the turn is incredibly difficult, certainly on something like the DAX. You know, if you're on a very slow market, you know, spot gold on IG hardly moves at all. Some of the commodities just trug along. Then that's fine, but it's actually a wide stop in relation to the asset. So you need to be looking at the ATR. And this all comes down to this section here. Oh, well done, girl. Got my cuff, because we all know we like a cuff. Well done, like Winky as well. The ATR. What's the ATR got to do with it? That'll tell you the breadth of market, and if you're looking, say, on an hourly candle, it can also tell you how far that hourly candle's going to go, give you an idea of what the stop is. Now, just because it says it's got an ATR of 20 on an hour, you don't just put in 20, because you know it's going to 20. You want to let it breathe. So how do you do it? Well, for argument's sake, if your 20 pips is £1 a point, okay, you've put into the market 20 quid. So that's your investment. Your £20 is going into the market. But I've just told you, you can have a candle that is 20 pips. And it can do it, boom, in 1 hour, quite easily. So how do you do this? Well, as long as you've analysed correctly, because that is the first step of any trade. The trade must be right before you've even pressed the button. You should have a good idea what's going to happen. And if you don't, do not press that button. You wait till the conditions are correct. But if you did 50p a pip, that now allows you 40 pips of movement, but the cost is exactly the same. Now, what I'm driving at here is investment of trade, and then what you're looking at on the other side is your profit, your return on investment. It's a different concept of thinking. What you are doing is you're working out your trade first, and you're seeing if the 20 pips initially is correct for the asset that you want to trade. Now, if it's tight and it's too tight, your position size is way too big. So if you half your position size, you still have the same of an investment. And don't worry about the money on the other side, because that should be all into the equation to start with. All right. What you're looking for is to move from here to here. That is it. But what worries me, and you see it all the time, is you have a testing candle that has a huge wick in it like that. And that wick could be 30 pips. Why? Because the markets probe and they test where they're at the bottom. You'll often see a classic V formation, but a V formation very often becomes a W formation, because it'll come down, it'll move up, it'll come back to where it's been, but when it's where it's been, it'll flush. And it's because they know the stop's there. It'll soak them out. Then it'll carry on its journey. So let your trade breathe. And the easiest way to do it is whatever position size you're going to do, half it and double your stop. Simple stuff. Because that way it'll increase your win rate, help your psyche, and ultimately make you more money, as that statement has just shown. So cherish your thoughts, drop it in the comments. Always welcome to hear them, and I answer every single one of them. And if you want to try the 5%ers, which is the statement you've just seen, there is a 5% discount link in the description. So as always, guys, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all in the next one.